Hey everybody, Smart Silver Stacker here. Hope you're doing well. So the global trade war continues to escalate by the day. The US and China are implementing retaliatory tariffs back and forth. Huge amounts of uncertainty are ruling the markets right now, but something very interesting is happening in the gold and silver market today, and that is that the metals are rising. In fact, the gold price is up more than $100. And what makes this so interesting is that this is happening in tandem with rising US debt yields. So the debt market is selling off at the same time that the gold and silver prices are rising. And this suggests that what investors view as a safe haven may be shifting. And this has major implications for the precious metals moving forward. So that's what we're going to talk about today. Let's get to it.
The worst day on Wall Street since the crash of 1987.
We're now down 43%.
This could be the most serious recession in decades.
Protect your retirement with gold and silver IRAs. Learn more at stbullion.com/IRA. So the price of gold is back over $3,000 today, a move that may lead many stackers to feel that they are being priced out of the gold market. But the good news is that these days you can always stack 1/1000th of a troy ounce of gold at a time with gold backs. All right, so the price of gold, as you can see, has a nice green candle on today's chart, up $110 right now, close to $3,100. That's almost a 4% move higher in gold. That's very significant for a market like gold, which is a very large and liquid market. So clearly there is a major safe haven bid occurring here. And the chart for silver is also looking pretty good. Silver's up about 2.2% right now. And if we zoom this chart out, you can see that it's actually back within the trend channel that the bull market in silver has been following for the past year plus. And if we get a close above this bottom blue line here, that's a very positive signal for silver. It could indicate that the risk of a major drop is diminishing. But the really interesting thing here is that this move in the precious metals is occurring alongside a rising U.S. Treasury yield. So this is the yield on the 10-year U.S. Treasury. If we look at the 5-day chart, you can see that this has risen by 5.89%. Right now it's up to 4.4%. This is an indication that in this environment of uncertainty and trade wars, investors, look what they're doing. They're selling U.S. Treasuries because remember, when you sell bonds, the yields go up. So this rising yield indicates a sell-off in U.S. bonds, and yet they are bidding up the price of gold and silver. So what investors perceive as a safe haven may be changing here. Now, I did a write-up on this in a newsletter that I published earlier today. If you haven't signed up for my newsletter yet, you can sign up with the link down in the description. It is 100% free, and I don't turn all of these newsletters into videos, but today I do want to touch on some of the points that I mentioned in this newsletter. I did a brief recap on what has happened so far, and we all know at this point that on April 2nd, quote-unquote Liberation Day, President Trump announced a huge tariff package, way more aggressive than investors had initially anticipated. It was tariffs on imports from 185 countries, and Trump singled out China specifically, calling the move a necessary decoupling from the CCP's economic warfare. The initial reaction was actually a decline in U.S. Treasury yields, along with a major market sell-off. And what that indicates is that investors initially were piling into U.S. Treasuries as a safe haven as the amount of uncertainty rose on the back of this burgeoning trade war. However, since that time, the markets have been digesting the longer-term implications of these tariffs, a full-blown trade war, rising inflationary pressures, greater geopolitical instability, and retaliatory economic action, which is exactly what we have been seeing. I mean, today, the Trump administration implemented tariffs of more than 100% on China. China has now implemented retaliatory tariffs on the U.S. of 84%. So things are kind of getting out of hand here, and nobody knows exactly how this is going to play out. And what has happened in the past few days is that yields have reversed course, rising steadily, now up to over 4.38%. That is the highest level in months. And at first glance, these rising yields seem rather counterintuitive. It's not just fear, though. What this is a repricing of bonds. Foreign demands for treasuries may be weakening as a result of the tariffs and the trade wars. Inflation expectations are being revised upward. Even Powell has confirmed this, that there are inflationary fears associated with tariffs. And that makes sense because we import so many things from around the world, especially China. I mean, think about that. A 100% tariff on China, you can expect the prices of most things, the cheap Chinese manufactured goods at Walmart and on Amazon, to increase significantly in light of those tariffs. And here is a threat which is looming in the background, that China still holds nearly $1 trillion in U.S. treasuries. That's if you combine the Chinese holdings with Hong Kong's holdings. And they could retaliate by reducing or dumping their holdings. Now, the 10-year yield is beginning to reflect this. The bond market is starting to sniff out a deeper structural issue here, and it could be a potential break in the global order that has underpinned demand for U.S. debt for decades. Think the petrodollar system, how the U.S.'s main export has been dollars for years, and really we've been living high on the hog based on the productivity of our foreign trading partners. Now, what we're seeing today is a break higher in gold and silver. Initially, following the tariff announcement, you saw gold and silver both sell off. So gold briefly dipped below $3,000. Silver got absolutely smacked, had a huge sell-off. This was likely a dash for cash. In the case of gold, people were covering margin with the one thing that hadn't really dropped by selling some of their gold. And in terms of silver, silver is an industrial metal, so fears of a global economic slowdown led to a sharp sell-off in silver. However, silver is now back above $30. Gold is now pushing $3,100, and you've got rising treasury yields. So this defies traditional expectations. Typically, rising yields will actually put pressure on assets like gold and silver that are non-yielding, because you can get a better yield with treasuries that have the higher yield, and that can lead to a sell-off or a declining price in gold and silver. But that's not what we are seeing. So the rally here is reflecting mounting concerns about systemic risk, global trade instability, and the long-term viability of U.S. debt markets. If we've entered into a period of deglobalization and trade war, that may be a big problem for the U.S. debt market. If we're left to domestic buyers of debt, you can expect yields to go significantly higher. Now, in terms of China's treasury holdings, they have been gradually reducing their treasury holdings over the past several years, slowly selling off the amount of U.S. debt that they have. And a lot of this has to do with their fears of escalating trade wars, sanctions. They saw what happened to Russia with asset confiscation following the Ukraine war. And at this point, it looks like those fears were justified. If one of the U.S.'s biggest lenders starts pulling back in retaliation, this could force the Federal Reserve's hand into yield curve control, quantitative easing, and massive currency debasement. If rates continue rising unchecked, the Fed risks triggering a cascade across the financial system, from unrealized losses on bank balance sheets to a freeze in credit markets. Just remember what triggered that financial crisis back in March of 2023. It was rising U.S. bond yields, which led to losses, unrealized losses on bank balance sheets. The Fed had to step in and intervene there. In fact, you can look at the Fed balance sheet, and this little blip here was that intervention. They had to introduce the BTFP to bail out the U.S. banking system. That was an emergency lending facility. But what's going to happen as a result of this trade war, if things really do escalate and the Chinese sell off treasuries in a big way, resulting in spiking yields, it will likely be bigger than the spike in quantitative easing. And again, this is the Fed balance sheet. So this was a huge amount of debt purchases during the 2008 financial crisis, and then during the COVID crisis, when they bought over $1 trillion worth of treasuries in a very short order. And that led to the spike in inflation that we experienced in subsequent years. But here's the difference. Such a policy pivot, especially during a period of trade war and geopolitical tension, would come with its own cost. The perception that the Fed is monetizing debt and losing control of inflation. Now that is where gold and especially silver come into play here, because silver is a monetary metal, but it is also a critical industrial metal. It's an input for high-tech manufacturing, solar energy, electronics. The industrial consumption of silver increased drastically over the past decade, and the U.S. doesn't produce enough silver. We import significant amounts of silver every year. Right now, if we see a breakdown in global supply chains that coincides with an increase in demand due to the reshoring of U.S. manufacturing, which is a stated purpose of these tariffs, and it's a major objective of this administration, along with global safe haven investor demand, the upside move in silver could be explosive, especially when you consider how cheap silver is relative to gold at the moment. And I wrapped up this newsletter with some final thoughts that I think are worth pondering here. The global financial system is entering uncharted waters. That's undeniable. What started as a tariff announcement is now rippling through bond markets, safe haven assets, and geopolitical alliances. Rising yields, retaliatory tariffs, and precious metals bucking historical trends all point to one thing. We are witnessing a fracture in the post-2008 monetary and trade paradigm. And for long-term thinkers and contrarian investors, and I know there's a lot of those out there in the stacker community, this is not just noise. This is something to pay attention to, and it may signal a rare opportunity to position ahead of what could be a new cycle in commodities, monetary policy, and sovereign credibility. And it's always important to remember that the next decade won't look like the last. And I'm not the only person that this has occurred to. Earlier today, Deutsche Bank warned that a potential intervention may be required by the Federal Reserve in the U.S. debt markets. We've seen a sharp rise, as I mentioned, in U.S. Treasury yields. And if this situation continues, this is according to Deutsche Bank, the Federal Reserve may need to take action. This is from George Saravelos, the bank's global head of FX strategy, as a circuit breaker or emergency quantitative easing. And he stated, if the recent turmoil in the U.S. Treasury market continues, we believe the Federal Reserve will have no choice but to urgently purchase U.S. Treasuries to stabilize the bond market. This could be similar to what we witnessed a few years ago in the UK gilt market when there were spiking yields and the Bank of England had to get involved with emergency QE. But the difference is that this would be the Federal Reserve, the U.S. world reserve currency, and it would be taking place at a time of major economic uncertainty, and therefore it has the potential to light a fire under the dollar price of both gold and silver. Now here's an update from Secretary of Treasury Scott Bessent. He says that the convulsions currently in the bond market are not systemic. He says that it's because of some very large leveraged players that are experiencing losses, but said it is nothing systemic. And he went on to say that he does not believe that China is currently a big seller of treasuries. He said this is one of those deleveraging convulsions that happened in the fixed income market, and added that it was taking place among very large leveraged players who are experiencing losses. But my takeaway from that would be that if we're witnessing the current spike in U.S. Treasury yields absent Chinese treasury selling, and this trade war is continuing to escalate, who knows what China might pull next? And if they do begin to dump treasuries, you're going to see this spike in yields accelerate in a drastic way. And that is the sort of thing that would require intervention from the Federal Reserve. So look, my takeaway here is that there's never been a better time to hold some physical gold and silver. When you look at the charts of gold and silver, it's possible that we may not get another sharp pullback. Now I'm looking at gold right now. It looks like it's giving up some of the gains earlier in the session. Right now it's up about $75. That's still a very strong candle. Silver remains within this. Now, anything could happen here, right? You got to keep that in mind too. Markets are being driven by headlines right now. So you could see some capitulation on the part of China. You could see the Fed make an announcement about cutting rates or returning to QE. That could cause a huge move in the markets here. Volatility is the name of the game. But the nice thing about being a stacker is that when you go look at your stack, regardless of what the paper price is doing, the amount of ounces, whether it's gold or silver, it doesn't change, right? You still have the same number of ounces. So that's one reason that I think in this environment of uncertainty, physical, tangible bullion is an asset that's not only critical to hold. It's not financial advice. This is just my thoughts, by the way. But it's also something that can give you some peace of mind. But let me know what you think in the comments down below. If you like this video, make sure you check out the one that's popping up on your screen now. Thanks for watching, everybody. Stay safe and happy stacking. Smart Silver Stacker out.